Okay, this is going to be a brief tutorial on how to prepare two key financial statements, the income statement and then the balance sheet. Our focus this week, as you know, is on the income statement, but I'm going to go through both statements and then we'll come back to the balance sheet again next week as well. So the first statement prepared is the income statement. The income statement reports the business performance for the period. So the period could be a month, a quarter, or a year. And it's when we talk about the business performance, we're talking about the sales, the expenses, and the profit or loss. So a simple format for an income statement is the following. I take revenues or sales, those terms are used interchangeably. I deduct expenses and I come up with net income. This is also called the single-step income statement. A service business, this is all they have. They have revenue, they have expenses, and the difference is operating income. Now we do break out the expenses and we'll get to that a little bit later on in our discussions, not this week. So an additional step is for a manufacturing and merchandising company is to add in something called cost of revenues. And the reason that for merchandising and manufacturing companies we have cost of revenues is because they sell inventory. So when they sell their product to others, there's a cost that they incur for that product. So if you go to a Costco or go to Amazon and you buy something, they have purchased that inventory from a vendor. So that's an inventory cost, or what accountants call the cost of revenue. So the difference between the sales price and the cost that they pay to their supplier is the gross margin. And then come the operating expenses. So we subtract the operating expenses from the gross margin or gross profit. So gross profit and gross margin, the terms are used interchangeably, just as revenue and sales are used interchangeably. The other term that you may see in terms of cost of revenue, you may see cost of sales or cost of goods sold. So there are terms used interchangeably, but if you think about it from a high level, it's a pretty straightforward equation. We've got sales or revenue at the top line, both for service, manufacturing, and merchandising company. If I'm a service company, the next line is my operating expenses, and I'll list out the details of those. It might be rent, utilities, salaries, etc. But they all are considered operating expenses. And then I have the difference is my operating profit or loss. Going to a manufacturing or merchandising company, I start with my sales or revenue. Then I deduct from that my cost of producing that, or my cost of acquiring that. That can be called cost of goods sold. It can be called cost of revenue. It can be called cost of sales. So these, unfortunately, in the accounting vernacular, these terms are used interchangeably. But the difference between those revenue and cost of revenue or cost of sales is called gross margin, or more often now, gross profit. And then I subtract the operating expenses and I come up to a net income or operating profit. So revenues are earned for the sale of goods or services which I'm in business to produce and sell to my customers. So one thing that's important is that revenues occur when the sale is made. So when I've made the sale, I've shipped the good, delivered the service, I can recognize the revenue. The payment often comes at a later point in time. So there's often that disconnect between when I've shipped the good or service, or when I've delivered the item to my customer and when I collect it. Okay, but from a revenue recognition perspective, once I've fulfilled my end of the bargain, once I've shipped the good or delivered the service, then I can recognize the revenue. So expenses are incurred when the business either receives goods in services or services, and payment has not necessarily been made. So I incur utilities, I incur rent, I hire people to work for me. Once that time period's over, let's say I'm looking at how did I do this past month, anything that I've incurred, even if I have not yet paid for it, even if I haven't received the invoice for it yet, I'm still should recognize as expense. So expenses are recognized when they're incurred. So, and this is the accrual basis of accounting. So when we talk about single step versus multi-step, we're going to break out the income statement. And in our course, we're only going to go through income from operations or operating profit. So we're not going to worry about these non-operating items. That's really for advanced accounting. But income statement, sales, revenue, sales or revenue, cost of goods sold or cost of sales or cost of revenue equals gross profit or gross margin, minus operating expenses equals operating profit. And that's really as far as we're going to be interested in focusing during this semester. These other items that are below the operating profit level get into a lot of very specific accounting details that you would only study if you were taking advanced accounting courses. So our main objective in this course is for you to be comfortable with understanding, being able to find and being able to read and understand the income statement, the balance sheet, and the statement of cash flows, and the accompanying footnotes and management discussion and analysis that goes along with them. But we're not going to worry about all the other accounting details, which really there's no need for most managers to understand it, and certainly nobody would explore that in an introductory accounting class in any case. So a little more detail on the income statement. So the cost of goods sold or cost of sales represents the expenses a business incurred to buy or make a product for resale. So if I'm a merchandiser, Costco and Amazon, I don't make things. I buy them from suppliers and then I resell them to my customers. So if I'm a manufacturing company, Dell Computer, Apple, Tesla, I'm a manufacturing company, and so I have a cost of goods sold, which is based on the cost I incur to make the product that I resell to others. Service companies don't have cost of goods sold or cost of sales because they're not reselling tangible items to their customers. So we don't have to worry about that for service companies. So operating expenses are the usual expenses that occur in operating a business, and this applies to all types of businesses. So salaries, utilities, depreciation. And I know many of you don't know what depreciation is yet, but we'll get to that. It's a pretty simple way that we allocate costs for certain things over several periods. But basically, it's the ongoing expenses that we need to operate our business. So we started the semester by looking at individual income statements. And if you listed out your individual expense items, businesses have similar things. They have rent, they have salaries they have to pay, they have utilities and the like. And those are the cost of running any business. So as I mentioned, we're not going to worry about the non-operating items. It's really for an advanced accounting class. Nor are we going to worry about income taxes. So we're going to skip over those, and I really don't think there's any need for you to worry about them at all in this class. So next week, we're going to start to explore the balance sheet. So let me just introduce it in this brief lecture so that you at least can start to think about it. So the purpose of the balance sheet is to report the financial position of the accounting entity at a very specific date. So the end of the year. How much do I have for assets and how much are they worth? So assets, as we know, are the things that I own. What do I have for liabilities, or the things that I owe to others, and how much do I owe to others? And the difference is what's called equity. So the thing about the balance sheet is that things always remain in balance. That is, assets always equal liability plus equity. This is also called the accounting equation. So assets are economic resources owned by a company. So here's some examples. Cash, everybody knows what cash is. Accounts receivable, we haven't really explored the balance sheet yet. So when we get to that, we'll talk about what that means. But it's basically money that my customers owe me. I can have some supplies that I'm going to be using over a period of time. Buildings, if I own the building. Equipment, if I have equipment such as automobiles, computers, and the like. Those are things that I own. So think about your own personal balance sheet, right? So you may have some of these things, and for a business, they may have more of them. They may be different forms, but essentially it's the same idea. And then on the liability side, this is what I owe to others, my debt or obligations. So there's something that will be called accounts payable. So that's when vendors ship me items, inventory in particular, and I agree to pay them later. And then there can be some other things that I owe to others, which we'll get to when we get to the balance sheet. The balance sheet's a little more nuanced and a little more technical than the income statement. The income statement is really a pretty straightforward statement. So the equity is simply the residual balance. It's the assets minus the liabilities equal equity. And it's commonly called stockholders' equity if the business is a corporation, which is what we're going to focus on much of this semester. So in the balance sheet, there are two different types of assets shown in the balance sheet. There are current assets and non-current assets. So current assets are just those assets that I expect to convert to cash and then within a year. Non-current assets are things that I expect to own and maintain for longer than a year. So things like building, equipment, and other things that I expect to stay with the business over a long period of time. And we'll see that non-current assets, we have to do certain specialized accounting treatment with. And we'll get to that later. Okay, no need to get to it tonight. So non-current assets, so current assets turn to cash within 1 year, cash, accounts receivable, inventory, and non-current assets are things that we expect to use for more than a year, land, building, equipments, and some intangible assets like patents or copyrights. And also on the liability side, we can have current, which means that I expect to pay the liability within the current year, or long-term, which means that it's deferred, that I'm not going to pay it all off this current year. So maybe I take a mortgage out on my property. That might be for 20 or 30 years. That would be a long-term liability. Corporations often issue something called bonds, which means that I'll send you a piece of paper and agree to pay interest. And typically those go 5, 10, 20 years in length. So current liabilities, again, we'll get into all this, things that we pay off in the current year. The term that we'll come to know is accounts payable, short-term notes payable, and other things that we have to pay off. And then long-term liabilities are not going to be satisfied in the current year, are not going to be paid in the current year. Mortgages, bonds, and the like. So we're not going to really get into stockholders' equity. I just want you to think about stockholders' equity as the difference between my assets and liabilities, the residual value of the business. We'll look at it briefly. There is something called contributed capital or paid-in capital. So that's the amount that investors pay into the company to buy the stock. And then there's something called retained earnings. That's the amount of earnings that the company has made that they've retained in the business. So when a company has profits, they can do one of two things with it. They can retain it and reinvest it in their business. They may want to buy some assets, or they may want to make a strategic investment. So they can retain it, or they can pay it out to the stockholders in the form of dividends. So retained earnings is just the amount that they've kept. So then there's contributed capital, which we're not going to worry about that either. So here's a brief review. So if you look at this problem here, what we'll be working on over the next couple of weeks is for you to be able to look at this and know what goes to the income statement and what goes to the balance sheet. Okay, so right now, for this week, we're going to focus on just the income statement. So in the income statement, we're going to find that there are certain things on the sheet that go to the income statement, and the rest will actually go to the balance sheet. So let's take a look. So we want to classify the accounts as assets, liabilities, revenues, or expenses. So the items in purple are assets, and let's not worry about the details this week. We'll come back to this example again. The ones in this pinkish salmon color are liabilities. The ones in yellow are equity. So those are all balance sheet accounts. So everything that's in white now is going to end up on the income statement. And the next color, this purplish color, is sales. And then the last color we're going to see here is the green one, and those are going to be expenses. Okay, so just take note of this and look at it. And, these are things that, we'll work through some examples like this in the upcoming week. So let's take a look at the income statement itself. So as we mentioned before, the sales minus cost of goods sold is gross profit, minus operating expenses is operating income or income from operations. So let's take a look at this particular example. In this case, we had sales of 100,000. So if you go back to the sheet here, you'll see there's the sales number of 100,000. That goes here. Then the next item is cost of goods sold, and that's taken from the given number here of cost of goods sold, $58,000. And then we have operating expenses. So we've grouped the operating expenses into, we've combined the utility, salaries, and supplies in total of $27,000. And the difference between, if I take my sales minus my cost of sales, that's gross margin. And if I subtract my operating expenses, that's my income from operations or operating profit. That's as far as we're going to go. And that's as far as our focus is going to be. These other items down here, again, is a little too nuanced and technical for an introductory financial accounting class. Okay, so that's everything we're going to cover this week. But I'd like you to go through these slides, go through, listen, and make sure that you understand how things are flowing. Okay, and we'll work on some exercises over the next couple of weeks to reinforce these basic ideas.